Yes, hi friends, good morning and welcome again once again. So today we're starting off with ICDS, something which was introduced about 4 years back, and in the initial intended purpose was more to bring in a sync in terms of how SSCs file their tax returns and remove the ambiguities in terms of the various accounting policies and procedures which our accounting standards give. And then subsequently we had Ind AS, we have accounting standards. Then we had section 145 under income tax law. So there were too many variables which were available for an SSC. Now, to bring in some sense of standardization on how tax returns and incomes are to be considered, these provisions were introduced. So, before as we move on, I would like to thank Bharti and Jugal for getting this presentation done the way it is at this point. These are some of the terms which have been used. I believe most of these are common, something which we would have seen in other webinars as well. So this is what we intend to see for today over the next 20-30 minutes. Why do we need this? What are the issue of method of accounting under income tax law, ICDS, and its applicability or otherwise? What are the notified ICDS? And we would be looking at ICDS 1 to 5 and how it gets reflected in your tax audit report. So that's the agenda for the day. Background, we had section 145.2, which categorically spoke about method of accounting and also gave CG, the central government, the right to introduce accounting standards. However, it was only in the year 2015 that the department came with its own set of accounting standards. And again, in September 29, 2016, it revised the earlier notification and then came up with the final set or the implementable set of standards at that point in time. The purpose, in too much of flexibility, and there was too much of differences between AS and IA. Ind AS, we had this fair value coming into picture, and primarily, as we discussed, friends, to bring in uniformity in terms of computation of income for tax purposes, ICDS was introduced, and again it applied only to business income and income from other sources. That's the ambit under 145 as well. So taxable income for PGBP and income from other sources, the SSC had an option to compute it either under cash or mercantile basis. So ICDS shall apply only to those SSCs who've chosen to apply mercantile system of accounting. And we also had a provision under 145 where if the assessing officer is not satisfied as regards the correctness and completeness of the financials, audit under best judgment assessment, which we have seen in one of our earlier webinars, can be initiated. As of now, we have 10 ICDS standards which have been notified and which needs to be adopted by SSCs while filing their returns. To whom ICDS applies, it applies to all SSCs who use the mercantile system of accounting. It, however, does not apply to individual or HU who is not required to get the books of accounts audited under 44AB, and people who follow cash system of accounting, and where income is chargeable under the heads other than PGBP and income from other sources. And please understand, ICDS is not required for the purpose of maintenance of books of accounts. It's required only for the purpose of computing your taxable income. So please understand, friends, ICDS is not for maintaining books of accounts, only for computing taxable income. And wherever there is a conflict between ICDS and Income Tax Act, the act shall obviously prevail because it is passed by the Parliament, whereas ICDS is more by executive order. Any terms which have not been defined under ICDS, the act shall have the final jurisdiction over its interpretation. Tax audit where the turnover exceeds 1 crore, where an SSE comes under presumptive income when it shows an income which is lower than what is prescribed under those limits. Similarly, where an SSE comes under 4484 and the total income is greater than the exemption limit. And 4484 categorically applies to an SSE who declares income on presumptive basis in any assessment year, and declares income under regular basis in any of the 5 succeeding assessment years. And again, for an SSC carrying on profession, if the income exceeds 50 lakhs and he opts for 44 ADA presumptive income, there again tax audit, and the income is lower than the threshold of 50%. Similarly, where an SSC where 44AB shall not apply, where he declares profits under presumptive tax at 6 or 8%, as the case may be, turnover is less than and his turnover is less than 2 crores. Similarly, to a person who comes under the ambit of 44BB or BBA, which specifically deal with the operation of ships, aircrafts, and mining and exploration businesses. So these are SSCs who are not required, who will not come under the ambit of 44AB. Now coming back, we have 10 ICDS standards notified, starting from accounting policy, valuation of inventory, construction contracts, revenue recognition, tangible fixed assets, forex, government grants, securities, borrowing costs, and contingent assets and liabilities. For today's agenda, we shall try and look at the first 5 standards. First one talks about accounting policies. So the fundamental premise, there are 3 assumptions. One, the entity is considered to be a going concern, so where there is neither an intention nor a possibility of a liquidation, and where there is consistency in the treatment of transactions from one year to the another, and the SSC adopts accrual system. So what is basically missing here is prudence is missing, materiality is missing, because those are standards which are principles which are required for your accounting standards. However, they are not a mandate for your tax accounting standards or ICDS. When we look at the difference between ICDS and AS1, prudence is missing. There is no need. Expected losses shall not be recognized unless any other ICDS provides for it. Because again, friends, we must understand before we start looking at the differences, the intent of ICDS is to ensure there is uniformity in tax collections, in tax computation, computation of taxable income, and of course there is a revenue bent to it. And impact, especially in the case of listed securities. So as far as materiality is concerned, there is no need for materiality as for tax accounting standards. So even if it's 100 rupees, it needs to be disclosed. Change in accounting policy cannot be changed without a reasonable cause. There is flexibility, and whenever there's a change in accounting policy, the effect of such change needs to be disclosed as far as your accounting standard is concerned. What are the disclosures required? All significant accounting policy, any change and why the change is being made needs to be very clearly affected. And if a particular change does not have an immediate impact but has a later an impact over future years, that also needs to be mentioned. Disclosure of accounting policies or changes cannot remedy a wrong or an inappropriate treatment of an item, where we call it as a qualified reporting. Such issues will not have an impact as far as tax accounting standards are concerned. The fundamental accounting assumptions mentioned in this standard need not be disclosed, and where they are not followed, then yes, let's say there's a case pending against NCLT and there is a possibility of a liquidation, then yes, obviously you need to mention that the going concern premise is violated in this situation. So that's when you need to mention. Otherwise, there is no need to mention that going concern analogy has been adopted. It is assumed. Next, uh, ICDS 2, which deals with valuation of inventory. Uh, it applies fundamentally to valuing an inventory on the basis of cost or net realizable value, whichever is lower. Again, a conservative principle for measurement of inventory. However, uh, this standard shall not apply to certain circumstances. Work in progress in the case of construction contract, because there's a specific standard which deals with construction contracts. Valuing shares, debentures, and financial instruments which are held as stock in trade, because again there is a specific standard for that. Producers' inventories of livestock, agriculture and forest products, mineral oils, ores, and gases to the extent that they are measured at net realizable value. Machinery spares, which we call as capital spares, which can be used only in connection with tangible fixed asset, and their use is expected to be irregular. So for these situations, we do not use ICDS 2, because there are specific transactions dealing with these standards. these circumstances. When it comes to inventory, what do you mean by the term inventory, or the features of an asset being held as an inventory? One, it is held for sale in the ordinary course of business, either which we call as finished goods, where it is in the process of getting finished, which is what we call as work in progress, and the last is where they are in the raw form, which are used for production activity, which is what we call as a raw material. Net realizable value is your estimated selling price minus the cost of completion minus the costs which are necessary to take it to the market. That effectively becomes a net realizable. If you were to sell your finished products today, what would be the price? Let's say it's 100 rupees. And you still need to, let's say, packing is pending and the cost of packing is 5 rupees for the transaction. And the cost to take it to the market, to the logistics, to warehousing, etc., is another 4 rupees. Your net realizable value will be 100 minus 5 minus 4. That was what will be considered to value your closing stock. This is more or less in sync with our accounting standard. Let's figure out where it differs in some time. Exclusions from cost of inventory: if there is an abnormal cost in terms of wasted material, labor, or let's say there is a flood and a lot of material gets wasted, then that would not be part of your cost of inventory. Storage costs, unless these costs are necessary in the production prior to a further production stage. Administrative overheads and selling overheads. So these are not deemed as part of your cost of inventory or cost of the inventory. These are below the GP items. So these may not come within the ambit. Storage, yes, if it is proved that it is part of your production line, and in which case it has to be deemed as part of your cost of goods sold. Differences, exceptions are fairly similar, except that machinery spares have not been considered, specifically dealt with under valuation inventory. Cost of inventories includes all costs of purchase, services, cost of conversion, and other costs. Cost of services have not been considered in AS2. Borrowing costs are included only when they meet the criterion mentioned under ICDS 9. Interest and borrowing costs are not usually included, but yes, if it's a CC and that's been used to fund the inventory, that obviously will get into it as long as within the working capital cycle. Position of opening inventory. So in the case of existing business, last year inventory value shall be the opening value. This has not been specifically discussed. And in the case of dissolution of a partnership or an AOP or a BOI, the NRV on the date of resolution or dissolving the enterprise shall be deemed for the purpose of valuing inventory. This has also not been specifically dealt with as far as AS2 is concerned. So what are the disclosures? Accounting policies which have been used should be disclosed, where a standard costing methodology has been adopted for measuring costs, how that has been done, and the fact that it more or less approximates your actual cost. Total carrying cost of inventories and its classification appropriate to a person. We would be seeing when we get to tax audit report, where there's a detailed list which is required to be given as far as valuation of as far as inventory details are concerned. So that's what we are expected to do. Next, ICDS 3 construction contracts, one of the most litigation prone areas. So construction contracts can broadly be categorized as two parts. One is a fixed price contract, the other is a cost plus contract. So in a fixed price contract, technically, let's say I'm going to build a 10,000 square foot building, and my cost of construction or my cost of building is very clearly fixed at uh, let us say 3,000 rupees a square foot. That's a fixed price contract. In a cost plus contract for the same 10,000 square foot, I have not agreed on what is going to be my earnout. It is only saying this will be the specification. Whatever is the cost of material, cost of labor, etc., the real cost of making it happen, plus I would have a margin of 10% or 8% as the case may be. That is what will get determined. So this effectively works out more for a transaction where there is not a fixed revenue, but only an effort plus markup situation. So construction contracts can be of either genre. When would you look at segmenting or combining construction contracts? So a single construction contract can be deemed as multiple contracts, and multiple contracts can be deemed as a single contract. Let us look at how. Let us say you have a contract with a developer to construct 50 villas in one particular place. And that construction of 50 villas will also include doing a landscaping, setting up a clubhouse, setting up sports facilities, setting up, let us say, gymnasium, etc., etc. So this is a composite contract where you have different types of contracts. For the villa, you would have given one price. That is, it's a 50 villas per villa, it's going to be 1 crore, that is 50 crores. For the clubhouse, you would have given one price. For the sports facilities, you would have given one price. So this is a case where even though it is one particular relationship, the contract covers a number of assets, and the construction of each asset or an asset class shall be deemed as a separate construction contract. So in this case, separate proposals would have been submitted for the clubhouse, for the villas, for the sports facilities, for laying down the roads, etc. And each asset has been subject matter of separate negotiation, and there shall be an accept or a reject clause for each asset. Costs and revenues for each asset can be identified. So this is a case where even though there are multiple assets, there's one contract for doing multiple assets, each of it will be deemed as a separate contract by itself. Now, the next is a case where there's a single customer or several customer, but it is treated as a single construction contract. Let us look at the case of building a 20-story building with 5 different customers. But your deal is only to construct a warm shell of 20 storied of 10,000 square foot each. That's your deal. So 200,000 square foot, and you will be charging them 3,000 rupees a square foot. Even though there are 5 different contracts with 5 different buyers to build for 20 stories, it will be deemed as a single deal if the group of contracts is negotiated as a single package and the contracts are so closely interrelated that they are in effect part of a single contract with an overall profit margin, and they are performed concurrently or in continuous sequence. So without finishing the first 5 floors, you cannot go to the next 5 floors. So the entire transaction shall be deemed as a single construction contract. Where the contract provides for an additional asset, such additional asset should be treated as a separate contract only if the asset differs significantly in design, technology, or function. The price of the asset is negotiated separately without having any relevance to the existing transaction. So we've seen where multiple assets built could be regarded as one contract, or one contract with multiple assets could be deemed as separate contracts as well. So based on facts and circumstances. So what are contract revenues? See, when we look at construction accounting for construction contracts, ultimately what is the intent, friends? You need to find out the bottom line. So bottom line for a construction business will be contract revenue minus contract cost. So what is a contract revenue? Contract revenue is the initial amount which is agreed at the time of contract, including retention. Variation in contract work claims and incentive payments, to the extent they are probable, they will result in revenues, and it is recognized when there is reasonable certainty of ultimate collection. So this is as far as the top line is concerned. Contract costs that relate directly to the specific contract to the customer on the terms of the contract, allocated borrowing costs in accordance with ICDS 9. Based on these, whatever cost you arrive, you will reduce it from the contract revenue to arrive at contract profits. Now, how does it compare with AS7? Retentions, contract revenue includes retention. There is no specific provision under AS7. Criterion for recognition of variation in contract work, claims and incentives, not specified. It's probable that the customer will approve variation. The amount of revenue can be reliably measured. Then it becomes part of the contract revenue. Early stage completion. So until the contract is 25% complete, it is deemed as your contract revenue equals contract costs. Here there is no percentage. It is recognized only to the extent costs incurred that are expected to be recovered in the earlier stages. Incidental income. Any incidental income, contract cost shall be reduced by any incidental income which are not in the nature of interest, dividends, or capital gain. For example, you have built a let's say you're a developer and you have built a model house For some reason, you give the model house on rent. Whatever yield you get from that, you will reduce it from your contract costs. Similarly, costs that relate directly to the specific contract shall be reduced by any incidental income that is not included in the contract revenue. Next, expected losses in the contract are recognized in proportion to the percentage of completion. Whereas when it comes to AS7, it is recognized in full. Again, look at the intent, friends. See, these are some of the issues where the income tax department, if you have completed 50% of the contract and you know that the contract is heading for a loss, department will not allow you to recognize 100% of the loss. They will say you will recognize only 50% because only 50% is complete. Whereas when it comes to Companies Act, you don't want a developer who is listed to recognize a potential loss only partially, because that will have an impact on the shareholders' perception of the company. So, which is why when it comes to accounting standards, we take a more conservative approach. When it comes to income tax, I wouldn't use the word optimistic, but it's more a, a, a pragmatic step where losses to the extent incurred will be borne, even though they could be specifically identified and there is a potential which is more or less likely to happen. Still, we will not go ahead ascertaining the entire amount of loss till the project is actually complete. Reversal of contract revenue, where contract revenue is already recognized as income in the books and it is written off in the books as uncollectible, the same shall be recognized as an expense. So under 36(1), this shall be deemed as a bad debt, and the conditions required for bad debts, like legal steps should have been initiated, and it should have been an actual write-off, and it should not be a provision for bad debts. All these things have to be categorically met for an assessee to be eligible to reverse a contract revenue. What are the disclosures? The amount of contract revenue recognized as revenue in the period needs to be disclosed. What is the method used for contracts in progress? The following must be disclosed: contract cost, advances received, and the amount of retention, if any. The disclosures are fairly standard as far as ICDS are concerned, very similar to your AS, more or less. Next, revenue recognition. ICDS 4 deals. So, revenue, when we talk about revenue recognition, we're dealing specifically with three types of transactions. One is sale of goods, second is rendering of services, and third, use by others of the resources of the SSC. Classic case could be interest, rent, or royalties, or dividends, etc. Revenue is your gross cash inflow, receivables or other consideration arising in the ordinary course of business. And in the case of an agency business, it is not your gross, it is only your commission which can be deemed as revenue. In the case of sale of goods, similar to what is mentioned in your accounting standards or similar to your Sale of Goods Act, where the seller of the goods has transferred to the buyer the property in the goods for a price, all significant risks and rewards of ownership have been transferred, and there is no effective control, and there is reasonable certainty in the ultimate collection after transfer. So then the revenue pertaining to sale of goods can be determined. So the title has to be transferred, there is no risk in collection, and the buyer holds no control over the goods. Then the sale is deemed to be completed. Rendering of service, slightly different, friends. Let's look at it carefully. It is recognized on a percentage completion method, where the services are provided by an indeterminate number of acts over a specified period of time. Then it shall be on a straight line basis. This is the first time you are seeing revenue being recognized on a straight line basis, because your accounting standards do not contemplate straight line recognition. Revenue from services contract with a duration of not more than 90 days may be recognized when the rendering of service under that contract is completed or substantially completed. So, for services, we have three bases: percentage completion, completed method, as well as prorated on a straight line basis over a period of time. But this completed will apply only for contracts without a duration of with a duration of not more than 90 days. Now, if it is more than 90 days, we go with the percentage completion method. What are the methods? When it comes to income tax, we have three. We saw percentage completed, completed contract, as well as straight line basis. But completed contract is only for smaller transactions where the time duration for completion is not more than 90 days. When it comes to AS 9, we have only 2% completion and proportionate completed service and proportionate completion. Dividend income only on receipt basis, where the owner's right to receive is established. So it is accrual as far as AS 9 is concerned. Recognition of interest or refund of any tax only when it is received. Here it is on accrual basis, because the company law or the accounting standard regulators believe that refund due will be received in time, and it is as good as receivable without any uncertainty. In a transaction involving sale of goods, the disclosures to be made: total amount not recognized as revenue during the previous year due to lack of reasonable certainty of ultimate collection, along with nature of uncertainty. Please understand, friends, you are reporting to an income tax officer, so obviously he is keen on items which have just slipped the recognition of revenue. Amount of revenue from service transactions recognized as revenue. Method used to determine the stage of completion of service transactions in progress. For service transactions in progress at the end of previous year, amount of costs, advances, and retention, fairly similar to your construction contracts. So these are the disclosures as far as your revenue recognition mechanism goes. And the last one for the day, we're looking at tangible fixed assets. So ICDS 5 deals with tangible fixed asset. So what is a tangible fixed asset? Any asset building, land, machinery, plant, or furniture held with an intention of being used for the purpose of producing or providing goods or services, and is not held for sale in the normal course of business. So here when we talk about cost, it shall be purchase price plus duties other than those which can be on which you can have a credit, like your SENMAT credit. Directly attributable expenses on making the asset ready for its intended use, like your trial run costs, etc. Minus trade discounts, rebates, grants, etc. Friends, you can, when you get into ICDS 5, you can see a lot of similarity between section 43 subsection 1, which deals with, and its explanations read there with, which deals with the actual cost of fixed assets. So this is what we use for the purpose of claiming depreciation under section 32. So treatment of expenses and cost in case of exchange of assets. So where a tangible fixed asset is acquired in exchange, uh, any other for another asset, then the fair value of the asset so acquired shall be deemed to be its actual cost. And when it comes to treatment of expenses, how it works. So admin overheads will be capitalized if it relates to a specific asset. Expenses are attributable to bringing the asset into working condition. So you buy a second-hand asset or a used asset and you try to bring it to shape for the current, for the new one, for operation. Expenditure incurred on startup and commissioning, including trial runs, shall be capitalized. Any expenditure incurred post the plant getting into commercial production shall be deemed as revenue expenditure. That's fairly straightforward. Self-constructed assets, costs that are attributable to construction activity and which can be allocated to a specific asset, shall be capitalized. And one interesting thing here is you need to ignore internal profit. So it's entirely on cost basis for allocation. Expenditure that increases the future benefits beyond previous standards needs to be capitalized. For example, you go in for a complete overhaul of a capex where you change the engine of a car that extends the life by another 5 years or 7 years. That needs to be capitalized. It should not be treated as revenue. Addition or extension to existing asset which becomes integral part added to the cost of the existing asset. Addition or extension having separate identity which can be used without an existing asset, treated as a separate asset. So these provisions are fairly established rules. So let's assume you build an additional room in a particular floor. It's a small room, so that will be part of your existing building. You build a separate floor, that floor will be treated as a separate asset. Difference between ICDS and AS10. So identification of assets and liabilities. Uh, Deferred revenue expenditure. though we don't have that concept of deferred revenue expenditure, but capital spares are effectively treated that way as far as AS10 is concerned. Whereas ICDS 5, capitalization of machinery spares when they are used only in connection with tangible fixed assets and the use is irregular. Position of revaluation of fixed asset does not require revaluation because income tax revaluation is a prohibited term, either upwards or downwards. Revaluation is provided for because as far as AS10 is concerned, fair value of the asset needs to be considered. Depreciation generally on WDV, except in the case of power or electricity sector assets where straight line method of depreciation is adopted. Comes to AS10, multiple methods can be adopted. Retirement, ICDS does not provide for retirement because we follow the block concept of depreciation. So irrespective of whether the asset is there or not, if the block is available, depreciation is continued to be available to the SSC. So retiring assets should be stated at lower of their carrying cost or net realizable value as far as AS10 is concerned. Disclosures, fairly straightforward disclosures similar to what we used to have for your depreciation schedule. Depreciation of assets or block, rate of depreciation, actual cost or WDV as the case may be, any SENVAT credit, if any, depreciation which is allowable, and WDV at the end of the year. So it's nothing but your depreciation schedule which needs to be disclosed. Yes, Mahesh, tell me. Moving on. See, the guidance note of ICAA for 145A is ICAA's perspective on this particular implementation. But what we also need to understand is the revenues perspective here. The intent of bringing in ICDS was, to some extent, in my humble view, undermine the premise of ICAA in bringing out accounting standards. It is not revenue neutral. If you look at ICDS is obviously not revenue neutral. It is pro revenue. It can't be revenue neutral because pro revenue, which is a fundamental purpose also. Because if you notice some of the differences, what we are seeing, simple example is you cannot assume losses entirely, even though you know the losses, right? So, which is why ICDS was mandated in the first place, because there were conflicting objectives of your regular accounting standards and ICDS. So, which is precisely why ICDS was introduced, and they are rightfully so because there were assessees were using their own systems of accounting. Some income, some heads of within the same head, some incomes were deemed as were deemed as income on accrual basis, some as cash. So, to put a full stop to all these multifarious practices, this was introduced. The ICA guidance, yes, I've gone through a lot of it is from that statement only what we are preparing here. The ICA view is only to protect the interest of the auditors, and they have said very clearly what is the duty of an auditor for implementing each of these accounting standards. So there is nothing much to comment on what ICA guidance is for this 145A and ICDS. But ICDS is here to stay, and it is only likely to get a lot more larger or complex as time moves on, because every time they come across a new situation which has not been dealt with, the number of ICDS standards are only going to increase going forward. Hope it answers. So moving on, so clause 13 and 14 of your tax audit report, which we saw in the earlier webinar on tax audit, categorically expect a tax auditor to give disclosures on ICDS. So 13 talks about method of accounting employed in the previous year, whether there had been any change in the method of accounting employed, any adjustment required. And clause 14 talks about method for valuation of stock and where there is a deviation in terms of the methods prescribed under 145. Now, this is a specific extract from your Form 3CD. So this is how the data needs to be keyed in. And wherever there is a change, you need to disclose the standard and what is the increase or decrease in profit consequent to applying the standard. So very clear, the intent of the revenue is to ensure that there is no leakage as far as consequent to application of ICDS, and the SSC has categorically followed ICDS. So similarly for valuation of stock as well. So these were some of the thoughts, friends, which we thought we shall share on this pertinent topic, especially given the fact that now we have one more month for tax audit to be submitted. Any questions would be more than glad to take. Else, catch up with you again on a later date on a similar topic of relevance. Thank you.